Welcome back. You're tuned into Business Lunch here on CNBC-TV18. Well, let's get to some numbers that we're expecting today. Dr. Reddy's, that'll be the one that'll be reporting its numbers maybe the next 1 hour or so. Ekta joins us to tell us what are we expecting this time around. Ekta.
Well, yes, Dr. Reddy's has been a complete outperformer this year, up around 28% on a year-to-date basis. In terms of the numbers, the revenue is expected to grow around 5.6%. Margins should probably come in stable at 22% and profit at around 481 odd crores. Now, in terms of the expectations, the key thing to be watched out will be the operational sustenance of Dr. Reddy's from Q3, considering that the margins were close to 25% last quarter. Watch for the impact from COVID-19 in terms of disruptions on logistics, API prices, etc. In terms of the US business, it is likely to be led by new launches as well as probably increased market share and anti-drug addiction drug Suboxone. India is likely to grow around 10 to 12 odd percent, and margins are probably expected to be aided by their continuous cost cutting initiatives. Profit range is wide, 413 crores to all the way at over 600 crores. Commentary with regards to COVID-19, Wockhart's acquired business, pending approvals for key drugs such as Copaxone as well as NuvaRing generic will be closely watched.
Thanks so much for that, Ekta. Well, in the next hour or so, I believe that UltraTech Cement as well, their numbers should be out. The board meeting started a couple of hours back. So let's see what they deliver. Remember, this is the big daddy of the cement industry with the largest capacity out there. Well, in terms of the numbers, consolidated expectation should come up for you on the screen. Expecting a bit of a degrowth, 3.5% degrowth in terms of the sales numbers. The operating profit could get hit a little bit harder by around 7%. And the margins should be more or less stable, or maybe a bit of a downtake, maybe 60 to around 100 basis points downtake is what we could brace ourselves for. The profitability as well should take a bit of a knock. We are working with a number of around 850 crores. What are the factors at play? Why do we see a bit of a degrowth on the top line? Because the street is really divided, in terms of the volume numbers. I was looking at it, in terms of volume, street is expecting nearly around 9 to around 12% in terms of declines. Could there be a positive surprise on that front? I've spoken to a lot of, sell-side analysts, and they said even after they put this out, maybe there could be a bit of a positive surprise on the volumes front. So let's wait by. For the time being, we're going with a degrowth of around 9 to around 12%. But realizations will support. Remember, they have exposure to North India, Central India. We know prices over there have been fairly good. So that's what, helps the top line, and in fact, doesn't, reduces the decline, because the volumes are falling by 10%. You're going to see the top line decline only by around 3.5 to around 4%. Now, EBITDA margins, what's impacting out them? You have higher realizations. They want to have any kind of benefit of operating leverage because they're selling less. So that doesn't play out. And the third factor is that input costs have come in lower. Remember, petrol prices have been lower, pet coke prices have been lower, and they use pet coke to a large extent. Management commentary is going to be key. What kind of capacity utilization levels are they at? How do they see demand going ahead as well? Those will be the vital areas, and maybe in fact some kind of debt number update as well. In the previous quarter, they surprised positively by some debt reduction. Can they do it again? Well, we'll have to wait by and see what comes out from UltraTech Cement. For the time being, let's move on. Even as the government gradually eases restrictions on industrial activity, migrant workers returning to their homes has caused trouble for the transport industry. Trucks find themselves stranded at warehouses with the level of idle trucks reaching near 70%. Alisha Sachdev joins us to fill us in with details on that story. Alisha.
Well, that is right. The recent exodus of migrant laborers has exacerbated the problems of the transport industry. We are learning that truck idling levels, which is the number of trucks currently not in use, has reached close to 70% despite there being high demand. In fact, utilization levels for trucks had peaked at 40% to 45% until last week and have now dropped to 30% and are likely to go down further. The demand-supply mismatch has already started to show on freight rates as well, which have already been hiked by 15 to 20% and are likely to increase by even 25 to 50% in the coming weeks if the shortage is not addressed. In fact, at the JNPT terminal outside Mumbai, which is the country's largest container port, deployment of trucks has gone down even to 15 to 20%. Currently, there are trucks being stranded at big warehouses across the country, but there is no labor available to load and unload these trucks. In fact, transporters are worried that going ahead, industrial output will also remain muted and warehouses too will work below capacity, and that will dent demand for the industry. Considering this scenario, transporters are looking at various options, one of them being the consideration to surrender their vehicles to the regional transport offices to relieve relieve them of paying taxes on these vehicles for the time that they're not being used. Remember that the government had provided extension for the renewal of statutory documents such as the motor vehicle insurance and national permit until the end of June, but the lockdown has also extended since then. The moratorium on EMIs, in fact, which also expires this month, and about 85 to 90% of the industry had opted for that, will also expire and will also expire by the end of this month. And small fleet operators especially are worried that they will be unable to pay these EMIs starting June. Now, going forward, all of these factors put together will dent the availability of trucks and drivers going ahead, and freight movement will be impacted. However, there is one sector, which is the FMCG and the food space, which has done better and will see a deployment of around 60% by the end of this month.
Well, former Chief Statistician Pranab Sen estimates that incomes to the tune of 14 lakh crore have been lost in the past 7 weeks of lockdown. Sen added that unless much more demand stimulus comes quickly, the GDP can fall by close to around 10% this year. Let's listen in.
Government has told all the ministries except 10 that their budgets for the year are going to be cut by between 10 to 15%. Okay. Right? So the net effect of these is that the fiscal stimulus is actually very, very small, practically non-existent.
Yeah.
Now, if that is the case, and this is where we rest, we are looking at a growth rate of somewhere around minus 9.5 to 10% this year. Immediate imperative is to ensure that the demand side, which was already in trouble prior to the outbreak of the pandemic, that is shored up.
Okay.
Because if that is not shored up, even if you give the corporates any amount of money, they are not going to be seeing demand at the end of the road. They are certainly not going to come back to normal production.
Well, earlier today, we spoke with Mark Matthews of Julius Baer, and he gave us his opinion on the markets. He said investors right now are looking for growth, not value. Added that the Indian equity markets facing the currency risk might be keeping people away. Let's listen in.
In this environment where we have very low growth, I mean, clearly this year's negative growth, and coming out of it, probably the growth is going to be constrained by the enormous amount of debt that has been piled on to prevent a complete economic calamity. In India, what I would say is that there is a value picture, very ironic, because historically it hasn't been considered a value market, but I think we can say that it is on around 2 times price book. That's about that's one times less than it historically has been. It's historically been closer to 3. But people don't want value right now. They want growth. And I think in a nutshell, that explains the underperformance of the emerging asset class. Some countries have the ability to respond with a lot of fiscal stimulus, and if they're borrowing in their own currencies, therefore it avoids a lot of depreciation in the currency. But in a country like India with its twin deficits, the general idea is that in order to really fiscally stimulate, you've got to let the currency go down. So I think I highly recommend investing in Indian dollar bonds. They have excellent yield, but in investing in the stock market, you have the currency risk. I think that's probably the biggest thing keeping people away right now.
Well, let's slip into a short break, but up next, people brace for the landfall of Cyclone Amphan, one of the biggest storms in 20 years. Details when we return.
In these unprecedented times, as markets turn volatile and investor fears increase, CNBC-TV18 helps investors create a pandemic-proof portfolio. Meet the Nawab of Dalal Street as he gets you insights from the finest financial minds.
A lot of the paradigms we thought were very reliable have gone busted.
Debt and credit is the best asset class at this point of time.
You always have stocks that are outperforming into the peak.
Wizards of Dalal Street.